One of the things that I've wanted to do on my YouTube channel here is make some videos showing and tracking some of my own personal investments. That's what I'm going to do here today. This particular strategy is an incredibly simple strategy that returned 27.68% between 1987 and the end of 2021. That means an initial investment of $10,000 would have grown to a final balance of $51,747,000 over this time period. That is freaking huge. And personally speaking, I've been investing in this strategy since 2015 or so. All right. Now, this ultimately does look incredibly good, right? Like, who would not invest in this to earn the 27.68% and sit through the 75% drawdown, which, mind you, is a large drawdown. But if you know that you're going to cash out and get 51 million bucks from this compound annual growth rate there above 27%, anybody can sit through that 75% drawdown, right? So why would you not invest in this strategy? Well, as you're going to see, and some of you guys may have caught on to this, I ended this at the end of 2021. Going forward, the last 15 months or so, I'm recording this in April, on April 10th, 2023. So on a monthly basis, we have 15 months out of sample. Going forward, the strategy has taken a huge hit. That said, I don't think it's the end of the world, right? And personally speaking, I think it is a great time to be contributing in the strategy. Mind you, that is not financial advice for you. That is my own personal thought, and that is guiding my own behavior. And only time will tell if we're right or wrong, but hey, I am going to share the progress of this here on YouTube so we can see for myself, right? And the reason why I left off this period after 2022, or from the start of 2022, was to kind of highlight the risk return profile so that you could see how good it looks, but then going forward, see how bad it did perform. Because I think it's important for everyone to know that just because something looks good historically, like this is done, like I said, why would you not invest in this if you're seeing this chart, that things can go south or perform not as good going forward. So keep that in mind. That is why I started off showing this chart with the most recent 15 months not included. All right. On that note, let's talk about the strategy. We'll look at how it's performed going forward and also talk about the risks. I am going to cover that stuff here. All right. So this strategy is incredibly simple. It would use just two leveraged ETFs, SPXL and TMF. SPXL is triple leveraged S&P 500. TMF, triple leveraged long-term treasuries. Hold them 50-50, rebalance quarterly. That is the strategy, but let's look at it a little bit deeper here and get a better understanding of things. So I'm going to take all of the settings off of this back test right here and kind of go from the beginning. All right, and what we're holding is S&P 500 using Vanguard's S&P 500 mutual fund as a proxy, VFINX, and then long-term treasuries at 50-50, also using Vanguard's long-term treasury mutual fund, VUSTX, and rebalancing annually. If we do that, we can see between this time period, the portfolio would have returned 9.85% annually with a max drawdown of 20.51%. That's a very good return for the max drawdown. This profile has a very good risk return characteristics. So to say, the characteristics of this portfolio are very good, holding 50-50 long-term treasuries and 50-50 equities. Equities being S&P 500. And I think if you went to any financial advisor and said, hey, this is what I'm doing, they wouldn't say this is bad. You cannot say this is a bad strategy. There might be good things about it. There might be bad things about it. There are some good and bad things about it, right? Good being that over this period of time, it's had all its equity exposure to S&P 500, interest rates were generally trending lower, etc. Bad, you don't get international exposure, yada, yada. But by and large, any financial professional could not tell you that this is a bad portfolio. This is probably better than 95% of portfolios that people create out there. Professionally advised, broad, diverse portfolios. Anyways, so, if you did this without leverage, anybody would say this is a fair portfolio. Nothing wrong with it here, okay? Now, let's talk about the risk characteristics here, because this max drawdown of 20.51% is low, even lower. It's even low for its stock and bond allocation, but it's incredibly low for that annual return there. This happens because we've got two very lowly correlated asset classes, two asset classes with very low correlation. And over a short period of time, they can even have negative correlation. So correlation is measured over a time period. Over a longer term time period, like a year, they're going to have low correlation. Generally, they both go up over time, right? So they have that positive correlation, but over a very short period of time, like a week, they typically, or a day, or sometimes even a month, they have negative correlation. So let's just kind of show this in a chart here. And I put the S&P 500 and long-term treasuries mutual funds on a chart. And this chart goes from September 30th, 2018 to the end of April 2019. And I said September, I think I meant November. Anyways, I think, what do we get? A 5-month period here, right? And we can see that when one zigs, the other tends to zag, right? Like we can see right here, S&P 500 being the blue line kind of goes down. The long-term treasuries go up. And, well, even more pronounced right here, S&P 500 goes down, long-term treasuries go up, right? So this generally has been how things have worked historically, right? Let's just pull this into the COVID era. We can see another pronounced kind of diversification value. That's what we're showing here in this lack of correlation. This looks good right here. I was going to kind of take the most recent time period off, where we've got these 15 months where treasuries have gotten crushed. But we can see again here, when one zigs, the other zags in 2019, in COVID, yada yada. So the low correlation and at some points negative correlation is really what holds this portfolio together. Okay, so let's go back to the backtesting tool right here. And to replicate SPXL and TMF, mind you, we cannot go back to 1987 with them because they did not exist. So to replicate it, and what I did for the first chart that I showed you is we applied 300% leverage, essentially 3x leverage, and then debt interest at 3%. Now, the tickers or the levered ETFs, SPXL and TMF, they do not use debt. They use futures contracts. So they're essentially getting interest-free debt, but they do reset daily. So they are subject to decay, which I tend to think of as interest. And the reason why they reset daily and why there's no longer reset period holdings out there might be some, but I'm not very familiar with them, but there's not many of them if there are, is because resetting daily prevents them from having an absolute collapse. Like broadly speaking, right? Like there could be some calamity that happens and they do collapse, but generally speaking, the S&P 500 would close if it were down 20% in a day. Okay, so at that point, the fund would reset. That prevents it from fundamentally going to zero. So 3x could lose 60% in a day, but not 100%. Anyways, we're gonna, kind of represent some leverage decay on this, or the futures resetting decay with 3% interest on this. And, I guess I'll touch on that decay. A lot of people say, oh, the decay thing is really bad, right? Well, it's not necessarily bad, right? If you factor it into your equation, like interest, you're kind of budgeting for it. But also, when things are in an extremely high bull market, like a rip-roaring up bull market, say 2021, in equities there, they can actually get more than 3x leverage. Not many people realize that, but you can get like 3.3 leverage on these things if they're resetting daily. Okay, so while you get decay on the downside, you can actually kind of get some like positive decay on the upside here. So that is how I modeled it here. And in doing this, you'll see, you're not going to see quite the return that I had. That's because I kind of goose it up a little bit. You'll see, obviously, we get nearly 3x, but not quite because there's that interest in there. Rebalance quarterly, right? So when you rebalance quarterly, you do get a little bit better of a return out of it. Not much, you're going to see it. It'll go to 27.68%, and then also increases your drawdown a little bit as opposed to rebalancing annually. So I guess you could run this either way. I do like to rebalance quarterly. Makes me feel good to go in there and rebalance it quarterly like I'm doing something, right? And in doing that, I am getting, over this time period, a little bit of a boost to my compound annual growth rate. So we'll click Analyze Portfolios, and you will see the data, or the performance that I had going, or the performance that I showed you on the initial chart there at 27.68%, 75% drawdown. Now, let's see how this thing has performed going forward, right? Or, beyond this here in 2022 and what we have the first quarter of 2023. And when we pull this up on the chart, you'll see, that compound annual growth rate takes a hit, and the max drawdown goes up, right? 77.55% is our max drawdown there. And that max drawdown, I believe, comes right here. Excuse me, that's annual return, but when we go to drawdown, the max drawdown was right there at the end of 2022. So again, whereas I was showing you, what looked good up to here, this thing looked freaking amazing, right? Well, since then, it's had a big, big, big drawdown in it. All right, and now what's causing that? And on that note, we're going to kind of turn this section into a what's causing that and a risk, right? Like, what are the risks? Well, what's really causing this here has been not just the decline in equities over the last year or so, but also the decline in bonds. Bonds in 2022 was, I believe, the worst year on record for the 10-year Treasury in terms of total return performance. And if I'm wrong on that, it was one of the worst, right? It was certainly a horrible year, right? So from the end of 2021, so 2022 till now, long-term treasuries are down 23.18% at the same time that the S&P 500 is. So through this time period, we've seen correlation increase, or we've seen bonds draw down. We've seen correlation increase. And then there's the interest and inflation, which are really the two factors behind the bond drawdown. So interest rates are rising. When interest rates rise, bond valuations tend to go down because the newer bonds are, being issued at a higher yield than the older bonds that you own. So therefore, their market value goes down. But then when there's inflation, the net present value of a bond also goes down, because a bond is basically valued at its net present value of its future cash flows and the coupon payment at the end. Okay, so when inflation is, when higher than anticipated inflation is anticipated, because mind you, this is all forward-looking and kind of theoretical or theoretical or based on anticipated numbers, that being inflation. When that is the case, and the net present value of the future cash flows of the bond are discounted for inflation to establish a market price on it, your bond values are going down. So the inflation and the interest rates have caused this bond calamity. At the same time, the stock market's declining, so you've got higher correlation. This has literally been, the last 15 months has literally been like the worst case you could possibly imagine for this strategy in these two asset classes. So, that is really what the risk has been, right? And the risk going forward, we've reached that now. Now, could it get worse? Yeah, it could get worse. But hey, personally speaking, I'm excited to contribute into this strategy when we've had this drawdown and it's performed so poorly. Because, usually when, how's the Buffett saying? When things go on sale, and when there's blood in the water and things go on sale, that's when everyone runs, but that's when you should be investing. Well, that is where we're at for this strategy. So I am really enthused to be contributing more to this strategy. Now, other risks, there could be stagnant growth in U.S. equities, but, then in theory, bonds should still be performing decently. And mind you, I think it's a great time now to be buying bonds if you're a bond investor. Mind you, I don't have a lot of exposure to bonds, largely because of my age at 33, and also the portfolio I have. I really, based on my situation, I really don't like holding a lot of bonds. Anyways, I do hold leveraged treasuries for this strategy. Anyways, what was I going to say? I think this is a great time to be buying bonds, or I think it's a great time period because just recently, in the last couple of weeks, Mr. Powell, the chairman of the Fed there, said that they anticipate slowly rising rates through the end of the year and then maybe even lowering them next year. And also, the inflation data is showing a positive trend, meaning inflation is coming down. Okay, so those two factors mean that it's going to be a nice tailwind for bonds to ride going forward. And mind you, that comes after they've had a very painful last 15 months. But risk, stagnated growth in the U.S., hyper growth or a lot of growth outside of the U.S. would kind of cause some pain to this. On the bond side of things, I really don't see any more pain than what we've already experienced here. Okay, this is a quick cut in here before I share my plans going forward. There's two other things I wanted to touch on. First, This strategy was actually published by somebody here on the Bogleheads board. Username was hedgefundie, and they basically published the same strategy along with some other variations that they've proposed, different allocations to stocks and bonds for different reasons, replacing the bond portion with leveraged utilities or leveraged oil and gas, leveraged commodities, things like that. So this is an interesting thread. I'll link to it. You can kind of go through and read through it. There's a lot of discussion about this strategy and the viability of it and variations, all that stuff, yada, yada, yada. The other thing was I wanted to show you what this looks like using the actual ETFs here. So what I'm going to do is we're going to look at this strategy from, say, 2010. I think that'll be the first full year of data for SPXL TMF. And we're still doing it synthetically here using, a leveraged ratio in this debt interest on the long-term treasuries and S&P 500 mutual funds. And now we can see that from January 2010 to March 2023, it returned 21.95% annually and also had that drawdown of 77.55%. Okay, let's just see how it performed using the actual ETFs. And I don't think I've actually looked at this, or if I have, I don't remember it. Haven't looked at it today while I was planning to make this video. So since those are levered, we can remove the leverage ratios and all that, and boom, let's pop this in here. And here we go. Okay, so what this shows is that, well, I like it, number one, and if you remember the numbers, you're seeing why I like it. That is, the actual compound annual growth rate of using the actual levered ETFs is the same, actually, 2 basis points higher, and the max drawdown is a little bit less. So this is kind of cool here, and I just wanted to do this to see how it performed to the synthetic strategy that I'd been showing you guys as a backtest, and I was really hoping that it performed just as well, and we can see here that it is performing, the synthetic is performing basically the same as the actual holdings. So on that note, let's cut back to now. Let's talk about my plan going forward here. I have created this account on M1 Finance. It is a retirement account. And in this account, I do already have some money in this strategy here. I've got this $18,605. Also in this account, I've got another pie holding one of my momentum strategies, but my plan is to slowly move out of the momentum strategy here by liquidating about $1,000 a month, maybe a little bit more, from the momentum strategy and moving it into the 3X strategy. And, as I'm doing the math in my head, $1,000 a month at 74K there, that's going to take me, 6 years or more, to liquidate, move over. I'll probably be a little bit more aggressive with it, and I ultimately want to move basically all of this account into this 3X strategy. Now, I said I've been investing in this strategy since 2015 or so I do have other accounts that do hold more in this strategy. I just figured it'd be nice to keep it a nice one separate kind of one account, one screen, so to display everything in for the sake of making videos here and sharing and tracking the progress on YouTube. So on that note, guys, I am going to do my first transaction here and kind of sell some from the momentum pie into the 3X pie. Now, M1 Finance makes this very easy to do. So basically all I have to do is click a button, right? And then when it comes time to rebalance, I basically just rebalance here. I think M1 Finance is a very good platform for people that want to hold a portfolio of things, that are fractional share based, so to say, right? And not worry about each individual share. That's why I like M1 Finance. And I've moved two of my retirement accounts over to M1 Finance, and I might move more over to M1 Finance. So far, I am liking it. It is easy. It's intuitive to use. The only downside to it is you're kind of limited on your trading windows, right? So I don't have M1 Finance Plus at the moment, so all my trades get executed at 9:30. If I did M1 Finance Plus, they could do it 3 p.m. But that said, M1 Finance has good margin rates, which is something that I also use on my taxable accounts. Overall, though, it's just much easier to click these buttons than it is to actually do the math and try to reweight things. And the fact that it has fractional shares and I can just sell, $1,000 here and it equally distributes it over $1,000 into my other pie is something that I really, really, really like. So on that note, guys, I'm going to, what am I going to do? I'm going to come in here to my momentum pie. I'm going to do a sell. I'm just going to sell $1,000, not $19.99. $1,000 sell, continue. Continue, it'll happen at 9:30 tomorrow. Done, and then we can come back to, oops, not there. We can come back to my overall portfolio and then my 3X and then do a buy because I've got $1,000 of buying power now. $1,000. And bingo, I am going to be contributing more to that 3X strategy going forward. Hey, on that note, guys, if you found this video interesting or helpful and insightful, you know the drill. Smash the like button, it helps me on the YouTube algorithm. And to follow my progress and to see how I actually do with this, if I make that tons of money at the 27% annually, or if I go bust, right, and it all goes to zero and fuck me, well, to follow that along, you know the drill. Hit the subscribe button. Hope you guys found this helpful and insightful again, and I'm calling it a wrap on that note and signing off.